right, good morning and welcome back, folks. I will be moderating this session with the capable help of our doctoral student, Jesse Gardner. So in this session, Elizabeth Blankespoor from University of Washington will present her research with Brad Hendricks, Joe Petrosky, and Christina Sin on real-time revenue information and firm disclosure. Following her presentation, my colleague Lorien Stice-Lawrence will provide a discussion, and then after that, we'll have time for Q&A. I'm assuming we're all squared away on the timing and the format of how to ask questions. So with that, Beth, take it away. I think you're still muted, Beth. Beth, I think your mic is still muted.
Okay, good. No, I wasn't still muted. My whole computer was frozen. It said, no, don't do two things at once. Okay, so first thing, let me just check. You can hear me, you can see my slides, right? All right, thank you for that patience. I will dive in now. And thank you so much for having us in the conference. As Shane mentioned, my co-authors on this paper are Brad Hendricks at UNC, Joe Petrosky at Stanford, and Christina Sin at American University. And this paper, Real-Time Revenue and Firm Disclosure, this paper and setting has been really fun to work with. So we're looking forward to sharing it with you all, hearing your feedback and suggestions. Let's dive in. Now, we're starting with the classic disclosure decision where a firm event happens. So the manager has private information that they then have to decide whether to disclose or not disclose. But the reality is that managers are receiving information all the time. We see examples of firms' information systems collecting real-time data on the company's transactions and accounts, and then giving it to managers through dashboards or other real-time tools. So then the decision is not a standard, do I tell investors about this event? But instead it's a series of small decisions where managers get information real time, and then they have to decide whether to disclose it now or check again tomorrow or next week and disclose it then. It's this idea of continuous information and continuous disclosure decision. So in our paper, we put this question in the structure of the fiscal quarter, where managers get real-time information flow throughout the quarter, and then they have to decide whether to disclose it at some point in the quarter, and if so, when. So more specifically, we use a measure of abnormal revenue each week as our real-time information in the quarter. And to estimate this, we start with a sample of customer credit and debit card transactions. We match them to the firm, we aggregate them to the week, we estimate what that revenue so far implies for the quarter, and then we compare it to the market's expectation of that firm's quarterly revenue. Then, using this measure of management's private revenue information, then we look to see whether managers actually issue revenue forecasts when they have significant private information, and if that decision varies with the timing of the news within the quarter. Now, we think our paper contributes to two broad literatures. First, the disclosure literature, because we use a detailed measure of both positive and negative private information that doesn't require as many assumptions about when managers get the information. And also by bringing in the concept of continuous information and how the disclosure incentives change during the quarter. Now, our other big contribution is to the literature on alternative and big data sources, where we ask the question of how disclosure choice fits into a world with high volume real-time data. Now, to motivate our specific predictions, it helps to look at the disclosure theory models. So in the classic one-period models, firms are more likely to disclose positive news than negative news, assuming, of course, that there are some frictions like disclosure costs or uncertainty about manager information, and that these frictions prevent investors from unraveling the non-disclosure. Litigation risk also enters the discussion, motivating managers to disclose at least some negative news. Now, if we think about a more continuous information and disclosure decision, though, say over a quarter, the role of these frictions can shift some. Marinovich and Varas discussed this in their 2016 paper on the disclosure of continuous information. And they start with the idea that investors will realize that disclosure costs are especially difficult in this continuous setting. And in the real world, we can think about how costly it would be to prepare these disclosures, talk about them every week or even more frequently. There's also this worry that really frequent disclosure can make managers myopically focus on the short term. And the more granular the information that's revealed by the company, the greater the benefit of the information to their competitors. So overall, disclosure costs can be an even bigger deal when we're talking about disclosing continuous information. And Marinovich and Varas show in their model that if investors internalize these extra costs and are in a setting with regulatory oversight and litigation that makes sure firms disclose the very negative news, then investors will interpret no disclosure as a lack of bad news rather than the existence of bad news. So essentially, this means investors don't expect managers to disclose their information every week. And that means that we wouldn't expect high rates of disclosure of private information. Now, the influence of the other two factors might shift slightly too, as we think about them in the context of a period of time like the fiscal quarter. So for uncertainty about manager information, investors are likely to assume that managers have less accurate information at the beginning of the quarter and more accurate at the end because managers have had more time to observe what's happened. Or put another way, investors, they're more uncertain at the beginning of the quarter about whether managers actually have some reasonable information to disclose. And going along with this, we expect the litigation risk to be higher at the end of the quarter than at the beginning, because investors are more likely to sue managers for not providing information when they think the managers might have had it. So that means that the cost of withholding negative news increases later in the quarter. So we would expect managers to stop withholding that negative news later in the quarter. Essentially, managers respond to changing pressures during the quarter. And the empirical literature gives us some evidence that's consistent with managers disclosing at the end of the quarter to avoid problems, with litigation probability and the litigation costs decreasing for firms that warn before the bad news comes out. And going along with this, if there's more investor attention at the end of the quarter, that's going to increase the likelihood that investors figure this out on their own and then punish firms if they withhold. So Marinovich and Varas, consistent with this idea, they show more likelihood of disclosing bad news as that probability of independent discovery or some kind of public news event increases. In the end, we predict more withholding of bad news disclosure initially, and then less withholding of bad news as we get closer to the end of the quarter. Okay, so we turn to examining these predictions empirically. And to do that, we start with our database of credit and debit card transactions from 2012 to 2016. So imagine the line items on your credit card statement. They're going to show the date, the merchant, the amount, maybe a category if you use an online system. We have 1.6 billion of those line items. And don't worry, they're anonymized, so we can't see what each of you bought last weekend. We have a total of just about 70 billion. So $70 billion. So our data provider is a firm that offers financial software to large banks. And in return, they get access to the transactions for cards at that bank. And they told us they gave us a random sample of their database. And we then took that, narrowed the set down to consumer-focused firms where credit card revenue is more likely to be an important part of their sales. And we gathered the names of the firm's subsidiaries from their SEC filings, and we matched all the parent and sub names to the merchant name in the card transactions. And then we cleaned the sample by taking out firms with more than 20% of their transactions that are in a different category than that firm's industry would suggest. And then at the end, we're left with 243 firms, or about 2,600 firm quarters from 2013 to 2016 in these 5 major retail consumer industries. As we're looking at this real-time revenue data brings some really significant advantages for trying to capture managers' private information. We have granular within quarter information about actual sales that the company made. So we avoid having to make assumptions about whether actions like searching the internet might lead to sales or signal sales. But the biggest challenge is that we only have a sample of the credit card sales. And if the company makes other kinds of sales, then credit card sales are only a portion of total revenues. If we aggregate our real-time revenue data to the quarter, we have 1.31% of the firm's CompuStat revenue on average. And this ranges from 0.2 to 1.7% from the first to third quartile. Now, to our credit, this is a bigger proportion than other credit card studies, which have averages that are more like 0.002 to 0.6% of reported revenues. But more importantly, we work to validate this data in the raw form and in the abnormal or the news measure so that we have a better comfort that we're dealing with private information. So starting with the raw, first we find that the quarterly total of real-time revenue, we take all the real-time revenue aggregated to the quarter, that is 78% correlated with the quarterly CompuStat revenue. Then to get a sense for whether there's stability in the data during the quarter, we look at the pace of these credit card sales week by week. And in this figure, we're showing weeks in the quarter on the bottom, so fiscal weeks. And then on the y-axis, we're showing deviation from straight line revenue. So imagine a straight horizontal line. That would mean that the firm earned revenue evenly over the 13 weeks in the quarter. And we see that the median firm earns it nearly evenly during the quarter. There is variation in the sample though, with the quick earners, those in the 90th percentile, earning about 14% more of their quarterly revenue by week 6 than the slow earners, those in the 10th percentile. And we account for this variation in our main measure when we estimate managers' expectations. Like specifically, when we're trying to figure out whether the real-time sales is good or bad news, we use the pattern of sales recognition for that firm and that type of fiscal quarter, the 1, 2, 3, or 4, so that we can more accurately figure out the revenue pattern that managers are expecting in the current quarter. Let me get into this a little bit more. So to estimate managers' private information at a specific point in time, we create this abnormal real-time revenue measure. And first we do it at the fiscal week level, where the first fiscal week starts on the first fiscal day of the quarter, and then it continues for 7 days. And then the second week is the next 7 days, and so on. And we chose the week as our focus because, one, it's a reasonable period of time over which we would expect management to have seen the real-time data, possibly met to talk about it, and whether to disclose it. And two, it removes concerns about fiscal quarters that are starting on different days of the week for different firms and in different years. Now, this way, we have all 7 days of the week in every firm week observation. And we start by estimating the expected quarterly revenue based on the real-time revenue that management has seen so far. Now, this can get complicated, so let me use some pictures to explain this. First, let's assume that we're in week 3 of the quarter, and we've seen $5 million in real-time revenue come through for our firm in these first 3 weeks. If we look at this same fiscal quarter in past years, we could see that on average, our firm earns about 20% of its revenue for the quarter in these first 3 weeks. So our expected quarterly real-time revenue would be the 5 million earned so far this quarter divided by the 20% we would typically recognize so far to get that implied expected total quarterly revenue. If we show it on this chart, it comes to $25 million expected for the full quarter. Then we need to adjust it to the CompuStat level of revenue if we want to compare it to analyst expectations. So we divide that $25 million of implied quarterly real-time revenue by the firm's historical ratio of real-time to CompuStat revenue. So for example, if the quarterly real-time revenue in prior quarters is 1% of the firm's CompuStat revenue on average, we would divide the $25 million by 1% to estimate $2,500 million of expected quarterly reported revenue based on the observed real-time revenue so far as of week 3. Okay, we're all on the same page now. We then take that expected quarterly revenue, we subtract the analyst expectation for quarterly revenue right then, and we scale it by the analyst expectation. And this gives us this measure of whether the real-time revenue that we have observed in the quarter implies quarterly revenue that would be different from the market's expectation. And we can use this abnormal revenue measure as a way to see managers' private information. So we look at this measure. On average, the implied quarterly revenue is 6% above analyst expectations. And then we create a quartile abnormal revenue rank so we can separate the weeks when managers have clearly positive and clearly negative private information. So the lowest quartile, the clearly negative quartile, is 14% or more below expectations. And the top, or the clearly positive quartile, is 21% or more above expectations. And then we can continue our validation tests with this abnormal measure And we do this along 3 paths. So first, we look to see how it's correlated with future truth or realizations based on the financial statements. Essentially, we're looking at unexpected quarterly revenue, how what actually happens with revenue is different from the current market expectation. And we see that this unexpected quarterly revenue is positively correlated with our abnormal revenue rank measure. So essentially what we're saying is we can help predict what will happen for the quarter's revenue with this measure. And second, we look to see how it's correlated with future truth based on stock market movements. Here we're calculating abnormal returns from the end of the current week through the end of the quarter. And we see that these returns are positively correlated with our abnormal revenue rank measures, even after controlling for size, book to market, and momentum. So our measure looks like it has information based on accounting realizations and stock market response. And then third, we look to see if it's correlated with signals of what management says and does. Starting with what managers say, for the subset of observations that provide forecasts, we find that the abnormal revenue rank measure is positively correlated with the news in management's forecast. And for what managers do, we turn to insider trading. And I'll talk more about this later, but weeks with the most negative news, that bottom quartile, they're more likely to have more insider sales, which looks like managers acting on private information. Now, all these outcomes provide comfort that we're really capturing private information of management about how revenues are likely to be different from market expectations. So now that we validated our measure of private information, we can get to our disclosure prediction on whether firms are withholding bad news disclosures. And we focus on revenue forecasts so that we have the most direct connection to our information measure. And we create an indicator for whether firms are providing a revenue forecast during the fiscal week. And then we regress that on our abnormal revenue rank measure, on control variables, and on firm and time fixed effects. And we find that as the abnormal revenue rank increases, firms are more likely to provide a revenue forecast. And when we use our abnormal revenue quartile indicators to highlight those weeks with the most positive news, that's that abnormal revenue rank high, and weeks with the most negative news, that's abnormal revenue rank low, then we see that the positive relation is really driven by firms that are withholding forecasts during weeks with the most negative news. Essentially, managers are less likely to disclose their bad news. We then ask how the disclosure changes during the quarter, and specifically whether firms stop withholding bad news as the quarter end gets closer because the cost of withholding increases. And we use 2 variables to capture time passing in the quarter. First, fiscal week, where it ranges from 0 to 12, and then an indicator for the period after the announcement for prior quarter earnings. So focusing first on column 2 with the top and bottom quartiles of revenue news, we still see withholding of negative news during the first week, but the probability of disclosing the bad news increases as the weeks in the quarter pass. And in column 4, we see this similar pattern of withholding bad news in the first part of the quarter, and then not withholding bad news in the later part after the announcement of last quarter's earnings. And in fact, we see the asymmetric withholding of negative news pretty much disappear by the end of the quarter. So this really confirms our prediction that the costs of withholding can vary during the quarter and potentially change disclosure incentives. And the next 3 tests, we look at whether this pattern of withholding initially and then disclosing the bad news holds primarily in the subset of firms where disciplining mechanisms are stronger. Because if this is about the cost of withholding increasing, then some market participant or institution has to hold that stick over managers. They has to create that pressure for them. And we find just that. The disclosure pattern of initially withholding and then disclosing negative news is most consistent in the subsets where the disciplining is stronger, where there are more analysts covering the firm, or where there is more institutional ownership, or where there is greater litigation risk. Okay, now going back to our initial prediction, a question is whether part of this is driven by managers being uncertain about their own information. Because if managers aren't sure of the accuracy, they'll be less likely to disclose. And it makes sense that managers might be less certain about information at the beginning of the quarter. They haven't observed as much of the quarter's sales, and our main prediction relies on the assumption that investors believe this to be true, and thus don't punish as much for withholding negative news at the beginning of the quarter. Now, when we look at the absolute difference between the implied real-time quarterly revenue and the actual real-time quarterly revenue, we see that this difference gets smaller later in the quarter. That absolute accuracy of the implied revenue, it improves as time passes, and changing accuracy could affect managers' disclosure decision. Even if managers have accurate information at the beginning of the quarter, though, they could still pool, they could still hide with the rest of the managers. And as long as investors don't expect managers to have accurate information early in the quarter, the cost of withholding negative news remains low, and we would expect less disclosure of negative news at the beginning of the quarter. In essence, there are two paths to affect the disclosure decision: the actual accuracy and investors' perception of the accuracy, and both are interesting. But when we control for this absolute accuracy of the implied real-time quarterly revenue, we still see the pattern of withholding and then releasing the negative news later, which suggests that investor expectations are driving at least part of this finding. Now, finally, we look at another action managers can take with this information, and that's insider trading. Now, as I mentioned before, we see more insider selling in the weeks when managers have the most negative revenue news. And if we incorporate the disclosure decision too, then we see that this insider selling is concentrated in the negative news weeks without the disclosure, suggesting that instead of disclosing or abstaining from trading, managers are disclosing or trading. And this is consistent with the Billings and Cedergren's evidence of insider selling when managers don't warn about bad news. Now, overall, we find that real-time revenues are informative, and using our granular measure of private good and bad information, we find that managers initially withhold negative information earlier in the quarter, and then they release it as the quarter progresses. This pattern is most consistent when the disciplining mechanisms are there to increase those costs of withholding. And the pattern holds even if we control for the absolute accuracy of the implied real-time revenue. These findings build on a rich literature by bringing detailed evidence of disclosure decisions around managers' real-time private information. Well, thank you, and we look forward to your feedback.
All right, great. Thank you, Beth. Appreciate that. And we'll turn it over to Lorien now for discussion.
Okay, excellent. Here, let me share my screen. Okay, perfect. All right, I'm Lorien Stice-Lawrence. Thank you so much to the editors for asking me to discuss this very interesting paper. Thanks to Beth for making my job easy, for writing an interesting, or Beth and her co-authors, they helped too, for writing an interesting paper. So let's get into it. So to give you a brief overview of what I'm going to talk about, first, I'm going to briefly go over a summary of the results. Beth obviously just did this, but I'm then going to use my summary to springboard into talking about how we can position the contribution of these different parts of the paper in the overall literature. I'm going to give you guys my spiel on big data that I like to plague PhD students with. We're going to think about generalizability and some cross-sectional results, and we're going to do some fun polls. So get ready to do some polls. Okay, so if we break up this paper into just a few pieces, very simplified at a high level, the first piece of this paper is this real-time measure of managers' private information that the authors have constructed using this really interesting transaction level data from debit and credit cards. So this is sort of the cool data aspect of the paper. And the authors then use this measure to come up with two key main findings. The first thing that they're showing is that managers are more likely to withhold negative news relative to sort of neutral or positive news. And then they show that this tendency to withhold negative news changes over the course of the quarter. So you're more likely to withhold negative news at the beginning of the quarter than at the end. And the reasoning they give for that is that as you get closer to the disciplining event of the earnings announcement, when everyone's going to find out your news anyway, this sort of serves as an impetus for you to come clean. And from each of these two main findings, they have a corollary finding. So first, as Beth was just telling us, they find that insiders trade on undisclosed bad news. And they also find some cross-sectional variation in this time series result based on analyst following and institutional ownership and litigation risk. So overall, looking at this paper, the main theme of it is they're looking at how do managers respond to getting real-time performance feedback. So in that vein, I'm a couple slides into my discussion. I'm going to ask you, how do you guys think it's going? And I'm going to have Riley turn on a poll for you all, and you guys can vote and tell me how well you think that I'm doing, going from abysmal to spectacular. And just like managers, throughout the quarter can observe their real-time performance. I can see this too. This is sort of like the beginning of the quarter because it's the beginning of the discussion. And managers, their disciplining event is the earnings announcement. For me, it's the REMO reception at the end of the day when everyone can talk about how they voted regardless of what I tell you all. So it's going to come out in the end anyway. And then the question now is, based on the results of the paper, am I going to disclose the results to you? So I'm going to have Riley close the poll for now. And you know what? Oh, yes, the results are very interesting, but I think, maybe we'll come back to this later. I don't think we have time to talk about, I'm doing great, of course. Obviously, the poll results show I'm doing awesome. And for completely unrelated reasons, I just wanted to show you this picture of a kitten, because of course I was doing excellent in the poll and I don't need to change your opinions at all. Okay, so going back into the paper, remember, it's about real-time performance feedback. Here are the different pieces. And if we then take these pieces of the paper and position them in the overall literature and think about their relative contribution, for many of these pieces in the paper, we can look at them and say, well, that piece in and of itself isn't necessarily a novel contribution because there have been some papers looking at related things with real-time feedback or other data's or other papers with cool data or other people looked at negative news. So if we pretend that I am the world's meanest, least reasonable, and least meticulous reviewer, then I can sort of say, for a lot of these things, there isn't really an incremental contribution because someone has looked at that even tangentially. Except, even if I'm the world's meanest reviewer, if we look at this time series dynamic that the authors are documenting, then nobody's really looked at that before. And it's really interesting, this time series dynamic that they're documenting of withholding early and then disclosing later is something new about the paper. And I think the authors do a really good job highlighting this in the writing of the paper. And I just wanted to highlight it again in my discussion. If you don't remember anything else about this paper, remember that they document this time series dynamic that as the disciplining event of the earnings announcement gets closer, time's up for managers and they can't withhold bad news anymore. Okay, now if I take off my mean reviewer hat and remember that I'm actually a discussant, so that's luckily not my job, but also I'm a very nice reviewer, so I hope you get me. If I am a little bit more generous in looking at this, well, for example, there have been some papers, for example, documenting cross-sectional variation in bad news disclosure based on litigation risk, but they haven't looked at analyst following or institutional ownership. And actually, a lot of the results in the literature are almost basically contradictory, where they're showing that as litigation goes up, you're more likely to disclose negative news, which is a little bit weird, and it's kind of hard to think about. So I'll talk about that later. And yes, there have been some other papers trying to come up with a real-time measure of managers' private information, but to be quite honest, this paper has the best measure. It's the least noisy, it's the most direct, most related to what we're interested in, which is revenues. So that's sort of a nice aspect of the paper. And yeah, there have been other papers with cool data and, this fruit or fraud it all paper that's trying to get at the same sort of thing with real-time revenue, but they use, web traffic and intent to buy. But, the credit card transactions that this paper is looking at is new to the accounting literature, and I would say really interesting in and of itself. And it's something that I think we should have more research looking at. There was a bunch of other things in the data that would be cool to look at. And yes, there have been some other papers showing that managers are more likely or are less likely to disclose negative news, but there are some results showing basically the opposite. For example, Kazik and Lev show that if litigation risk is high, managers are more likely to disclose negative news. So all of this to say that a lot of the pieces of this paper are related to a lot of the prior literature. And so they're not looking at something new, but that doesn't mean there isn't a contribution. There are some conflicting results here. It's really complicated. There are a lot of moving pieces, So there's a benefit to looking at the same thing again in a different setting with different data, so that as we do a bunch of different studies on this, overall we can figure out, what's happening here based on the cumulative body of knowledge. Okay, so at this point, I want to hone in on one aspect of the paper and talk about this cool data part. And this is where I get on my soapbox, and this is my spiel to the PhD students that I'm always giving them when they're talking to me about cool big data sets that they want to write a paper with. Not all of this is necessarily applicable to this paper in particular, and I'm sure a lot of the faculty already know this, so just I'm addressing myself primarily to the PhD students. So if you're thinking about doing a paper with big data like in this paper, first, think about, is it conceptually different? So can you use the data to answer a new question that hasn't been looked at before? Or are you looking at an old question and answering it with more precision? And that matters because it changes how you're going to pitch the contribution of the paper. Another thing to think about is big data is big, so there's lots of it. But often there are few subjects depending on how you aggregate the data. So in this paper, they have many transactions, but they're looking at about 240 firms. So depending on how you aggregate, you can still run into power issues even if you have big data. Don't forget this. And similarly, you can run into issues of generalizability if you're restricted to a specific industry. Next, big data is really big and it can be noisy. So let's not let the quantity of the data convince us of its quality. You can come up with a really clever measure for an interesting construct, but it may or may not be a good measure. It could be noisy and it may only be tangentially related to what you're interested in. And you can spend a lot of time cleaning the data to get there. And then lastly, and I would say absolutely most importantly, is that often I see papers with really interesting data and really boring research questions, because it's very difficult to reverse engineer an interesting research question from interesting data if you didn't already start with a question. So I urge PhD students to think before you leap, and before you invest a lot of time and money and sweat and tears and broken marriages and homes into getting this data and using it, think about what's the interesting question that you're going to look at with it. And if the question by itself isn't interesting, then don't do that thing. Okay, so if I take one of these pieces and apply it to this paper, let's talk just a little bit about generalizability. So remember, this paper looks at how managers respond to real-time performance feedback and they make disclosure decisions. But of course, the first order effect is they make operational decisions based on this feedback. So that means that by the end of the quarter, when they are when they're going to disclose, they've had the chance to potentially have changed their performance based on the feedback that they received earlier. Which means that firms with long operating cycles who can't change turn the ship around quickly, they don't have as much of an incentive to delay bad news during the quarter, because if you're Boeing and you've been working on designing this airplane and starting to build it for 3 years, and you find out you have a design flaw 2 months before the quarter is up, well, there's not much you can do about it. So if you have a long operating cycle, it's going to be the same bad news now as it is at the end of the quarter. So ideally, what this paper would do would be to look at variation in the result based on changes in operating cycle length. Is this only for firms with shorter operating cycles? Do you see it with firms with longer operating cycles? Unfortunately, one limitation of this interesting data is that they're really only able to look at it for a set of retail firms. And those are the firms that are most likely to have a short operating cycle where we would expect these results to be strongest. So this doesn't change the validity of what the authors have documented in this study, but it changes how we think about it going forward in generalizing this result and in looking at the same question in future studies. Now, another thing that I want to talk about very briefly is there's some somewhat semi-puzzling cross-sectional results in the data, in that the authors find that there is no evidence that firms with low analyst following or litigation risk withhold negative news. And this is a little bit weird because when you think about it conceptually, these should be the firms where the cost of withholding negative news should be the lowest. They're not going to get sued. People are less likely to find them out. And there's some prior studies to show that. And one potential explanation the authors give is that maybe it's a lack of power because there's less disclosure in these settings. And they give some descriptives to try to back that up, but based on those descriptives, low litigation and high litigation risk firms have these voluntary forecasts about the same amount of time. So that I don't think is probably the main thing. It could just be that these are small firms and the real-time revenue measure is noisier for small firms if they're not captured in the data. So I think it would be really beneficial if the authors dug into that to see if that's what's happening. Maybe these firms tend to bundle their news more with the earnings announcement. I'm not sure, but if we rule out all those other things and we still can't figure it out, that's why it's helpful to look at the same question in a bunch of different settings over and over again, so that we as researchers can look at the same question from different angles to get a better sense over time of what's going on. Now, I have a couple other technical comments. I'm just going to email these to the authors in my slides. And at this point, I've only got one more slide left in my discussion, so I'm going to ask you again, how well do you think it's going? I'm going to have Riley turn the poll on. And remember, I asked you before at the beginning of the discussion when I had a lot of time when I could change my performance, for example, by showing cat pictures. But now there's not much more that I can do. And remember, the disciplining event, like the earnings announcement, but for me, the REMO reception is looming. So feel free to fill it in, and I'm going to have Riley actually end the poll now and share the results with us. Oh, excellent. And so as you can see, I did amazing, and I did equally amazing when I polled you at the beginning, obviously. But I think we've all learned a lesson about Zoom polls in live presentations. Okay, so let's close this and go to my final slide. So just to conclude, remember the heart of the contribution of this paper is in documenting this interesting time series variation in negative news withholding. Remember, big data is great if you have an interesting research question that is suited to the data. Remember that tests concentrated in a few industries may only show you part of the overall pattern, and we need a lot of studies looking at the same thing so we can figure out what in the world is going on. And lastly, Zoom polls can be risky sometimes. So thank you again, and I'm looking forward to hearing the discussion.
All right, Lorien, thank you, spectacular job. And I'm gonna go through some questions here. I'll try and batch some of the similar questions that I have for you, Beth. So the first one looks like it's a similar question was asked by Oliver Binns at INSEAD and Vicky Tang at Georgetown, but it sort of centers on the uncertainty angle. And so Oliver's question was, could it be that managers do not receive or process the information as timely as you are able because their firm's internal information systems are weak? And so maybe that feeds into some of this resolution of uncertainty, but one of the questions was, whether or not you could cut on, proxies for internal information quality.
Yeah, so that's great. We would love to be able to see inside the firm. And actually, before I dive in, thank you, Lorien, for a great discussion. We'll take all those into consideration as we're adjusting it. But so we would love to be able to see whether firms actually get the information. We chose a week because in conversations with practitioners and reading news articles and looking at the software that's available to managers for capturing and looking at this real-time data, the most plausible explanation was that, yeah, these managers are getting this information most likely on a daily or within a daily basis. They're seeing this all the time. And so going with the week, we're hoping that we're capturing most firms a normal cycle for getting the data and for making the decision. If there were a way to see variation in how firms how quickly they get the data, I think that would be really interesting. The question is, what would the measure be? And then would we see enough variation within a week? Would there be any that don't get it within a week that we could really examine? That would be the concern.
Cool. Before I ask the next one, I just wanted to give you a minute or two if you wanted to address any of the comments in the discussion.
No, it was great. We'll think about it more later.
Okay.
If it comes up in the questions, we can answer too.
Awesome, sounds good.
And feel free to email me. I'll send you my slides.
Yeah, all right, awesome. So the next question, I guess I'm going to kind of roll this into one, comes from Franco Wong and Lindsay Gallo. but it's whether or not the managers withhold bad news at the beginning of the quarter for two different reasons. Franco was asking whether they're planning to manage earnings upward over the rest of the quarter. And then when that doesn't work as expected, then they have to disclose the bad news. Lindsay's coming at it from a slightly different angle, which says that they see the bad news at the beginning of the quarter, but then they intend to take actions, offer discounts or run promotions or things to try and bump up revenue. So, a couple different angles to explain why they might not disclose.
Yeah, and that, at a broad level, I would see those, whether you're going to take real actions or manipulating actions, those all roll into this idea of how sure are managers of that information. And that's another reason that they might wait to disclose, right? So the basic one we talked about was managers might say, has the second week, I don't know if this is good information. Let's wait and see if it becomes better. The alternative is that they say, I'm going to do something else and it'll fix it. It'll go away. And so I'll wait until that gets fixed. And that could definitely be part of what's going on here and part of the story of managers' accuracy. Now, our test where we control for the accuracy of the measure does help a little bit with that, but we don't go more into the earnings management portion of it. But that's where the second to last test where we control for the accuracy of the measure, I think gives some comfort about at least if managers are waiting because they think they might change it. What we end up seeing is if they don't end up changing it, that even if we control for the accuracy of the measure, we do still end up seeing this pattern of withholding at the beginning and not at the end. I guess this is the basic idea. Is there could be many things influencing this. Part of what they're bringing up too. Yeah.
Great, thank you. So another question from Sudipta Basu at Temple. Just the question is, how do you handle 14-week quarters? Do you bundle them up into the final weeks group?
Yeah, it's a great question. So what we end up doing is we take whatever extra days there are for this beyond the 13th week and we put it into the 13th week. So we have 7-day weeks for 0 through 12. And then in the 13th, it can vary from somewhere between, I think it's 5 to 9 days. So that 13th week can be a little bit shorter or a little bit longer. But we wanted to keep the number of weeks constant.
Cool. Just a couple other questions here. This looks like one coming from just a Lorien side question. Have you examined the ability of your real-time revenue measure to predict actual revenues on various cross-sectional splits? So within low-high analysts, low-high institutions.
Yeah, we haven't done that. You're saying that the ability of our abnormal revenue measure, how does accuracy vary within the different subsets? Is that the question?
I believe so.
Okay. Yeah, we haven't, we've just brought in these accuracy measures where we're seeing that the accuracy improves as the quarter progresses. And that's been really interesting. We haven't done it by subsample. And that's something that we could look at if we think that would drive the disclosure decision. I think that that would be kind of some interesting descriptive evidence related to it. And two, maybe that comes into understanding differences in disclosure across those subgroups. So yeah, that's interesting. We can look at that.
Very good, very good. So I do have a question here because I'm partial to your insider trading test there. So it struck me, this is pretty compelling evidence, right? And so it struck me that if they're willing to violate 10b-5, and I like the way you frame it, right? It's not disclosure abstain, it's disclosure trade. But if they're willing to violate 10b-5, would they not also be willing to violate Reg FD? And if so, would you expect to see that manifest in the information and analyst forecast or trades by institutional holders?
Yeah, so kind of this question of, are they telling them on the side? I can't see what managers are thinking. And of course, there are going to be some that will take action. I think the question would be, what's the benefit to them? So if they're willing to violate the insider trading, there's a very clear reason, and that's this monetary benefit. To violate Reg FD and give that information to analysts and to institutions, that's something that they would want to think. I would want to think through what are the benefits that the firm or specifically the manager would see by doing that. More broadly, this idea of especially in current times, some institutional investors, they're getting this data themselves. They don't need managers to tell them that they're going to buy it straight from the data source. In our time period, that wasn't really happening. And one, we know that from articles and anecdotes, and two, we still see some abnormal returns related to this information. So You know, in that sense, could managers do it? Absolutely. Do they seem to be doing it in our time period? Not really. We still see that this is a strong measure of managers' private information.
Awesome, thank you. So it looks like we're right at the end of the session time. So thank you, Beth, for an excellent presentation, and Lorien for an awesome discussion and for all the great questions. Looks like we have a 10-minute break. So the next session is going to start at 10:55.